Let's talk about the most basic financial question any contractor needs to answer. Can you pay your bills? Not eventually, not when that next draw comes in. I mean right now. If your suppliers call, your credit card's due, your guys are clocking out for today, can your business cover what it owes? If you're not sure, or you're just guessing based on the checking account balance, then you need to understand your current ratio. So what is the current ratio? The formula is current assets minus current liabilities. So let's talk about current assets. Current assets are the stuff you can turn into cash within a year. Cash on hand, receivables, short-term investments, and inventory if you have it and it's liquid. Let's talk about things like current liabilities. What are current liabilities? Current liabilities are simply what you owe in the next year. Your vendor bills, credit card balances, your payroll, the loan payments due in the short term. So if you have $200,000 in current assets and $100,000 in current liabilities, 200,000 divided by 100,000 equals 2.0. So you got $2 in assets for every $1 you owe. That's like showing up to lunch with $2 when the bill is $1. Plenty of cushion. But if you've only got $60,000 in current assets and owe $100,000, that's 0.6 current ratio. Translation, you're $40,000 short and probably one delay away from a full-blown cash crunch. So what is a good ratio? 2.0 or better is strong. You got a cushion. If you're at 1.5 to 1.9, comfortable, but you need to watch for slippage. If you're between 1.0 and 1.49, that's thin. You can technically pay your bills, but any delay will hurt. But if you're below 1.0, you owe more than you've got. You're floating. If your ratio is under 1.0, you're not managing a business. You're juggling bills with prayer and caffeine. So why does this matter? Because the current ratio is your financial breathing room. It's your first line of defense when a job stalls or a client pays late, you have a material cost spike, or when payroll hits before your invoice clears. It's not about profit, it's about liquidity, your ability to keep the lights on without begging, borrowing, or robbing Peter to pay Paul. So let's talk about a real contractor example. I had a contractor come to me, 5 active jobs, said, I think we're doing all right. So I pulled his numbers. Current assets, $72,000. Current liabilities, $110,000. That means a current ratio, 0.65. He was 65 cents to every $1 he owed. Sure enough, 2 clients delayed payment. He missed a payroll. Vendors froze him out. And suddenly, he wasn't a contractor. He was a full-time bill negotiator. We cleaned it up, collected receivables aggressively, deferred some vendor terms, shifted assets to liquidity, and paused some non-essential purchases. 4 months later, he had a 1.6 ratio and slept a whole lot better. So how can you improve your current ratio? Number 1, you can collect receivables faster. Don't let invoices age like wine. Call, email, follow up. Number 2, manage payables wisely. Stretch your terms within reason. Don't pay faster than you're paid. Number 3, keep emergency cash. At least 1 month's expenses in a reserve account. That can go a long way. Number 4, limit inventory bloat if you do have inventory. Materials sitting in storage aren't assets, they're anchors. And 5, and finally, refinance short-term debt. If you're making massive payments this year, ask if it should be stretched over 2 or 3 years. Here's the final word. If you can't pay your bills, you don't own your business. Your bills do. The current ratio isn't flashy, it isn't complicated, but it's one of the clearest signals that your business is healthy or headed for trouble. So here's the bottom line check. Do you have $2 for every $1 you owe? Or are you hoping this month's job pays for last month's mistake? One's a business, the other's a balancing act with no net.